77 days ago, on the 10th of May, I started an investing challenge. My goal was to beat the market, something that 90% of actively managed funds fail to do consistently. So in order to do that, I have a very aggressive strategy. I have 12 stocks and 11 of them are green so far, with one of them returning 42%, which is ridiculous. I am going to walk you through my strategy, explain some of the thinking, show you some of my stocks, and then I'll show you what my overall portfolio performance looks like and how it compares to the stock market overall. And then I will also share what I'm doing next with this portfolio so that I can try and stay ahead. Alright, so first, let me explain my strategy because that might help you understand a little bit more about what I'm doing and why I'm doing it. This portfolio is set up to be very aggressive because I am targeting an annual return of 20% or more. Because I'm trying to beat the stock market, I have to target a return that is substantially higher than the 9 to 10% that the market will bring me if I just put all of my money into it without doing anything. So that means that although I am only picking stocks with high potential, the portfolio that I have is also relatively high risk. Remember that this is not my entire investing portfolio. This is just one of the many different investing accounts I have, and it is a relatively small proportion of my overall investments. And I set it up specifically as a challenge on the Stake Investing app. By the way, if you do like the app as I'm showing you and you live in the UK, Australia, New Zealand or Brazil, feel free to use my link in the description below to get yourself a free share worth up to $166, which is what Nike is worth as I'm recording this video. Anyway, this portfolio and all the companies that I'm talking about are part of my aggressive experiment. Do not just copy it or listen to what I or anybody else on YouTube tells you what to invest in. Always do your own research and due diligence. Make sure that your investment strategy aligns with your goals, because the likelihood is your goals don't align with what I'm doing over here. So because I am investing for high growth, the companies I've selected are mostly from my high growth squared bracket. I explained it in some of my other videos, but what it really means is that the company I think will grow substantially within their industry based on my projections, and I also think that the industry the company is in is also either growing massively or reinventing itself. So out of those 12 stocks in this portfolio, 2 are electric vehicle manufacturers, 2 are gig economy enablers, 3 are tech solution providers, 3 are tech hardware manufacturers, 1 is a financial sector disruptor, and 1 is a social network. Some might say that all of my eggs are very firmly in one technology basket, and they might be right. But you do have to take sides if you're planning to beat the market. You can't just go broad and invest in everything, because then you're just replicating what the market is already doing. You have to make plays based on the information that you have, and these are the plays that I am making. There are 3 stocks in this portfolio that are currently not doing as well as others. Micron is currently down 6.9%, which is pretty fascinating because my target price on them has a really substantial upside, or at least it had 3 months ago. If I haven't already, by the way, I will be making specific videos about each of the companies in this portfolio at some point soon. And the other 2 underperformers that I actually have talked about recently are Tesla and Palantir. Those 2 companies lagging behind actually makes a lot of sense. In fact, I would have expected Lucid Motors to also join them, but unexpectedly, they are actually doing pretty well. Both Tesla and Palantir are long-term plays for me, and their target price is heavily based on earnings that are further out in the future than some of the other companies. And so although I have a lot of conviction based on the models in the upside, I expect the path to those prices to be pretty bumpy and there to be lots of ups and lots of downs. If I have a 50% upside in a mature company, I would expect that upside to materialize much faster because their revenues and their projected earnings of which their value is based are not as far in the future. However, Tesla and Palantir are also the 2 stocks in my portfolio that my models show the highest upsides for. And my forecast over the next 12 months for both of them shows some really interesting numbers, and I am actually expecting that both Tesla and Palantir will move from being the lowest growing to, I think, the highest growing stocks in this portfolio over the next year. Fiverr and Etsy are my 2 plays in the gig economy space, and both are doing really well. I recently made a video about Fiverr where I was explaining why I still think they're ridiculously undervalued, and I'm going to be doing a video on Etsy soon. Now, most of these companies in my portfolio are going to be announcing their results this week and next week. Twitter actually announced theirs last week, and the numbers were really good. They pushed their share price up, and Tesla is going to be the first out of the rest. Their results are coming out tonight as I'm recording this video. I'm going to be doing an update on some of these companies after the results come out, so that I use the latest numbers, so that I can go and tell you what my projected share price on them should be, why I'm investing in them, and give you some insight. If you're interested in hearing my thoughts, looking at the models, and understanding why I'm making some of these decisions in a bit more detail, make sure you subscribe to this channel, and I'm going to be doing all of that in the upcoming weeks. Now, AMD and Apple are both sitting on about plus 16% in my portfolio so far, and the rest of the stocks are somewhere between the plus 20 and the plus 40% mark. So I made a little spreadsheet here to compare my performance to the stock market overall, and the index that I have selected that I'm trying to beat is VTI. It's very popular. It is the Vanguard Total Stock Market Index Fund ETF. I've made 2 deposits into stakes since I started, and I also got 1 free share that I cashed in. Remember, you can also get a free share by using my link in the description. I made my first deposit on the 10th of May, and the second one on the 15th of June. A grand total of $3,076.49, including that free share. Now, as I'm recording this video, the value of my portfolio is $3,495.50. That's a 13.6% return so far. That is really not bad at all for a portfolio that is less than 3 months old, with the majority of the money only going in a little over a month ago. I definitely had a very, very good start, and it may well be down to a load of luck, because I certainly didn't expect it to grow that quickly. Anyway, I actually went and worked out what the annual return is weighted by the time since I have made those deposits. And at the moment, my annual return is on a run rate of 125%, which is completely bonkers, and it is so far ahead of where I expected. It's definitely on track to beat that 20% target that I set myself. Now, when I started the challenge, the VTI index was on $218.43, and the current value is $227.46. So the stock market has grown by 4.1% since I started, which is actually not too bad. But I wanted to compare like for like. So I did the same time-weighted calculation for VTI, assuming that I go and invest the exact same amounts into the VTI index on the exact same dates, so that I can go compare like for like, compare the performance of VTI versus my portfolio using the same kind of metrics. And using those numbers, the return would be 3.5% so far, which is equivalent to an annual rate of 24.6%. Now, that's not a bad annual return for the stock market at all. In fact, it's really, really good. It's much higher than that 9 to 10% historic average. But so far, I am feeling very smug and pretty good, because this challenge has so far netted a return of 5 times higher on my portfolio, with that annualized rate of 125%. So here is my plan over the next month with this portfolio. I'm going to be doing an update on the valuations of each of these companies in this portfolio. Some of them I've already done very recently, but others I'm going to be doing more in-depth valuations on coming soon. And I'm going to be sharing all of them on my channel. I'm then going to look a lot more closely at 1 or 2 of these companies that I think maybe are reaching a price which is a little high versus what my target, without leaving enough upside in there, because some of them have grown considerably. I'm up 30 or 40% on some of them. Now, I need to see what the next set of results say, but it may mean that I will sell one of these positions. It may mean, we will find out. So far, I have not actually sold anything in this portfolio. I've only bought. I am a long-term investor, and I'm driven by fundamentals. But if some of the companies I invest in go through a rapid period of growth, and my math says that I have taken all of the upside that I thought was there, I will sell those positions. And that could happen in 5 years' time, in 10 years' time, or it could never happen. It could also happen in 3 to 6 months' time, as happened with Nvidia, where I sold all of my positions despite it being one of my biggest holdings in all of my other investing accounts over the last few days. It is absolutely critical to never be emotionally attached to your investments. I can love and believe in a company, I can love their products, and at the same time, I can still sell their stock, because the maths tells me that the price is too high. So in order for me to stay ahead of the market, I'm going to continue reassessing all of these companies continuously. However, there's also a huge risk that a big correction will turn up and wipe out all of my gains and put me behind where the market is, because my companies are relatively high risk, because my companies are high growth stocks. My portfolio has companies with very high PE ratios and valuations based on long-term prospects rather than short-term outlooks. And if there is a market crash, this portfolio is likely to get hit much harder than the market overall. But I am trying to strategically pick companies here where I don't think the long-term optics, the long-term expectations performance of those companies would really change in that scenario. So although their share price may fall as a result of this, I still think that those companies maybe will then bounce back just as hard afterwards because of the reasons for which I bought them in the first place. Now, if you enjoyed this update and you found it useful, please don't forget to smash the like button for the YouTube algorithm. Thank you so much for watching. I really, really appreciate it. And as always, I'll see you guys later.